Hey, what's going on, Cashflow hackers? It's Chris with Life 180. In today's video, we're going to be talking about what is infinite banking. And I'm going to be reacting to a video with JT with Pocket Watchers. I don't know who this guy is. He's an accountant, but somebody sent me the video and asked me to do a review of it. So or a reaction to it. So if you are somebody who is watching these videos and is curious, always feel free. You can email Chris at Life 180, send me a link to a video. If it's relevant to the content that I talk about, I'll do my best to try to react to it. And so for this video, what I want to do is kind of get right into this. There's this video. I got through the very beginning of the content, and we're going to be just kind of watching this video here from about 48 seconds in. But you can see it's a fairly long video. I've got it on 1.5x speed because everybody talks kind of slowly, and maybe it's just me, but I can't listen to things at 1x speed anymore. I just got too many things to do. So we're going to get into this. By the way, just kudos to him before starting. It looks like he started his channel a couple years ago. At the time he made this video 3 years ago, he only had 6,000 subscribers. Now he has 121. So dude, good job. Like, I've not watched this video yet. I don't know what he's talking about. I don't know what his reaction is going to be. I don't know if it's positive or negative. My assumption is it's negative because that's probably why somebody wanted me to review it. But I really don't know what I'm getting into here. I do know the Wealth Nation people. I don't know them personally, but I know they've done a lot of stuff on the content and topic of infinite banking. And I happen to be a big believer of cash value life insurance. I believe in whole life insurance as an asset. So I'm going to be interested to see what this accountant says in regards to how whole life insurance can work. And that's it. So let's go.
Pocket Watch. Infinite banking works as simply as this concept that I'm going to share with you. Would you rather keep more money in your business or less money? My name is Carmen. Hold on. All right. So the red flag number one. Red flag number one. That is a silly premise to put before anyone, right? Would you rather keep more money in your business or less? Infinite banking works as simply as this concept that I'm going to share with you. Would you rather?
I do agree with him. Like, those comments, those questions about, like, would you rather keep more or less? Like, it's kind of a question that's obviously like a bit clickbaity, and it kind of drives me crazy too.
Keep more money. Who would ever pick the other way, right? Life is about choices, Pocket Watchers, right? Would you rather keep more money in your business or less? Well, anyone who would be asked that question is going to say more. I want to keep more money in my business. But guess what? That's not how life works. You have choices in life. You have choices in business. If you have $50,000 in your bank account as a business, but you need to buy inventory, are there certain expenses that the business needs to incur so that the business is actually operating and is functional and is growing? The question is, well, do I keep the $50,000 in my business bank account, or do I buy inventory for $20,000 so that the business can actually operate? Choices need to be made. So this is a ridiculous question.
It's actually not a ridiculous question in that context. So typically with opportunity cost, and what I want to do here actually is take a second and understand, get people to understand one element of this that I think is really important to comprehend. So what I want to do is break down some of this concept of opportunity cost. So he's not wrong, but he's not right. Okay. And I don't like the way a lot of people define this opportunity cost conversation. And so basically what we have here is like, all right, so if we have cash, what we're doing is we're spending, in this example, he'd say $50,000. Okay. So what is opportunity cost on this $50,000? Well, opportunity cost is saying, all right, if I pay cash, why am I paying cash? Because if I were to finance at $50,000, then I am, and let's say I'm paying 10% interest, right? So that would be, let's just call it $5,000, even though if it's compounded interest, it's gonna, if it's amortized interest, it's gonna be much more than $5,000 over the term of the policy, but let's just call it 5,000. The idea is, for that first year at least, you're paying $50,000 cash, depending on how long, because that's the other thing, we don't know how much time or what kind of loan they would need. And so the idea of paying cash flow is I want to avoid the interest expense, right? But there is no flat expense, or there's no right or wrong way to do this. When you pay cash, you lose the ability to earn. So lose ability to earn. And I, like JT, do not edit my videos much. I don't do a lot of jump cuts, right? And so, so what we have here is we lose the ability to earn. And if we could earn 5% on this, or whatever percent, let's just question mark percent, what we could earn, that's the question. So what they're saying, when you borrow money, if you had $50,000 in a cash value life insurance policy, here's the power of it, right? So if I were to borrow, I'm not borrowing from my policy, right? So I'm going to borrow this $50,000 is going to be inside of the contract, right? I'm not going to borrow from the contract. I'm going to take the life insurance, LIC for life insurance company. They're going to give me a loan. Let's call it $50,000. They're going to pay me an interest rate, or I'm going to pay them an interest rate. Let's call it 5%. That's about what it is right now. So I'm going to pay $2,500 on this, right? But all the while, if the money in my life insurance contract, so my cash value in my life insurance contract is $50,000, and if I'm earning a 5% return, well, then that's 50 to 500. So I have this interest expense, right? No matter what, I'm going to pay this interest expense. There's no avoiding that. But the beautiful part about whole life insurance, when you borrow against it and you leverage it and you take this loan, you pay this interest, by the time you pay it back, your cash value never stopped growing, right? You have that additional money. So he's not wrong and they're not right. It's the way people talk about it that's misleading, but that's why I feel like we need to focus much more on the education side of this stuff and, be less divisive about the way we talk about it. But I wanted to start off by kind of getting to that point, and I'm sure I'll come back and have to reference this a little bit.
To start off with, this is a grifter's type of question. It pins the person who hears the question into a corner that you're obviously going to choose. I want to keep more money in my business. Well, of course, but that's not a realistic question. The real question is, for a financial plan for the business, what makes more sense? Keeping a large amount of cash in the bank, or making sure that you're investing properly in the business so that the business actually grows? That's the real question that business owners have to really look at. So
no, actually, the real question in the business is going to be what's the cost of capital. If you're focusing on expansion, you have to be thinking about what is the cost of capital? Like, what are my options? Do you want to, because he's talking about like it's an A or B conversation. No, it's not. I mean, you can pay cash. You could not. He's basically saying I could pay cash for it. I could just not invest in my business. You could go get other financing options. You could go maybe different types of financing options. You could use credit cards. You could get loans. You could get secured loans. You could get non-secured loans. You can get all sorts of different options with different interest rates and different payback terms and all these different things that as an entrepreneur, these are the variables that you have to consider. He's talking like an accountant. And so he's kind of being just as bad as they are when he's talking about it in these terms. And so, obviously he's trying to be a little hypey. I'm willing to bet I'm not going to like some of the things I hear them saying. I agree with him. I don't like this like kind of languaging that pins people into a corner. It's more marketing than it is education. I will say that I like what most of their content and what they typically come up with from a solutions perspective, but it's just, styles in the way that they get there. And so I'll be curious to see how this continues.
I mean, pocket watches, y'all already know. This, you got to be able to hear a grifter coming from a mile away. This is just, it's a stupid question to ask any real business owner, anybody who really understands how investing works. You can't have it all. You can't have the cash and the opportunity. Normally what happens is you have the cash, you see the opportunity.
Okay, like one thing here is, like I said here, you don't have both the cash and the opportunity, because what I showed on the board here, when you do this, right, and you go through this and you take this loan from the insurance company right here, this cash value, it's what I call your collateral capacity. I'll just write collateral cap. This goes down to 0 at this point in time. So as we start paying the loan back, instead of paying the bank and paying interest, or, as we, whatever, this will grow. It'll, as you make your first payment of $500, you're going to have $500 in there. As you make your second payment, you'll have $1,000. You recapitalize this fund. Meanwhile, when you get done recapitalizing and paying this interest expense, you're going to have the number will grow to that number. So you're not going to have both. What you're doing is you're controlling the cost of capital and controlling the opportunity cost. All the while, by the way, any good accountant is going to be able to work out, if you do it the right way and you have your business structured properly. And this is not personal financial advice, but this $2,500 interest expense, if it's for business expense purpose, is going to be a deduction, right? And so this is something that you need to consider. That's so he's obviously, like, I get what he's saying and I get how he's triggered. I will say that. And I get why. I totally understand why he's triggered because of the languaging they're using, but it's very apparent to me that he really doesn't understand the fundamentals of this stuff. And JT, if you want to have a conversation about this, I'm really not being critical of you. I totally hear what you're saying. Reach out to me and I'm happy to do a video with you on it. So it'll be good.
You invest the cash into the opportunity that will grow your overall net worth. That's how life works.
Yeah.
In your business or less money? My name is Carmen.
Less money. I'm picking less money.
The idea of keeping more money in your business is something that we can apply to just our everyday life, how we interact with the banks and the overall our contribution to our economy. Because let's think about it, the way Carmen and I utilize our funds, the way you and your family utilize your funds, and the way your neighbor utilize their funds contributes to a bigger picture, which is our economy. And our contribution is what keeps this whole thing in motion. And that's what we need to think of our money as a way of keeping our economy in motion.
Jump cut.
Oil that keeps this thing going.
Jump cut.
I'm sorry. As a YouTuber who does not, I don't edit my videos, right? It's a one shot. That's what I do. I do a one shot. I don't have time. If I actually took the time to edit my videos, I would never produce any videos. Okay. So I can spot a jump cut in an instant. Jump cut, right? Boom, boom. He must have said something that he didn't like or something happened. He had to, had to chop that one up. So I always laugh when
probably just got uncomfortable.
The more lubrication we have, the more smoothly it goes. Now, let's start thinking about this in the form of our contribution using the banks, because we are talking about infinite banking, right? So the very first point we want to make is let's talk about savings. Savings is very important to our system. Now, before we get into the rest of this video, make sure you subscribe to this YouTube channel and hit the notification bell so that you're notified when we post new videos.
All right, let's go. Come on.
Now, Darius just mentioned savings being the number one point that we want to talk about in this video. And the main thing that I want to bring back to your attention is what Darius was saying about the economy. So if we think about our household, your neighbor, and your mom and dad, your brother and sister, each of these individual units make up their own micro economy, if that makes sense. So when you think about your own economy, our household, your household, how much money do you want to keep?
I did a video
on that. How much money do you want to keep? How much money do you want to keep in your micro economy? As much as possible, and that would be ideal. So when we think about spending,
I mean that's just simply taking a look at your budget, right? So if you are a person that makes $5,000 in 1 month, right? If you make $5,000 in 1 month, but you have expenses that are $4,800, that means you only have a little bit of wiggle room of $200 each month to use towards saving and investing. Now, that's a good start. It's better than being negative, but you need to really take a look at your budget. You're spending way too much money.
I think it's more than that. My guess is they're going to get into it, and I don't want to spend too much time responding to all the little things he says like that. So I'm going to keep going. I don't even like the word budget. I like the word personal P&L because budgets, I think, are restrictive. I don't think you can shrink your way to wealth. I think you have to think with an abundance mindset, with a creation and value creation mindset. And to me, a monthly P&L, if you're an entrepreneur, then you're thinking about how do I create more? And you're always with a P&L, it's effectively like a budget for your business, but you're thinking in terms of creation. You're thinking in terms of expansion. And so I would really encourage everybody to think about your personal budget. Instead of a budget, think of it as a personal P&L to get your mind and your subconscious in alignment with expansion. And so it's just very obvious to me that this guy's more of an accountant, which, I don't mean that critically at all, but it's as somebody who's run 15 businesses in my life, and most of them successful. And I run a big organization now and have 4 businesses that I'm running at the same time right now. The words I hear him talking about and the things I hear him saying, it's obvious to me that he doesn't think like an entrepreneur. Maybe I'm wrong, but that's just kind of what I'm hearing.
Money. I mean, a simple way to look at it, and I say it all the time, a simple way to look at it is look at it at 50, 30, 20. You should be only spending around 50% of your monthly income on your expenses, your needs, the things that you have to have. So we're talking about food, clothing, shelter. That should be 50%. Then you have 30% of your money that's still left to spend on your wants, the things that make life worth living, the luxury items, the fun stuff. Then you still have 20 left. And that is what you use to save and invest and, be able to create opportunities to build your overall net worth.
Well, he's got to bring in taxes into that equation too. So I don't know if he's including taxes in the 50%, but that's something to consider.
But how do you get to that point? It all starts with the fundamental building block of having a budget. Most people are in a bad financial situation because they don't have a budget. They don't really have a set amount of how much money they're going to spend on a certain thing each month. So you rarely hear someone say that, oh, I can't go out to eat with you today because I've already met my budget for going out to eat, right? Or I can't do this or I can't do that because I've already met my budget. Normally people just spend and spend and spend until there's no money left. And then they still spend because you have the opportunity to use credit. You can borrow money to spend on, lifestyle expenses. So that's the issue. If we all just go back to the very first building block of financial planning, which would be having a budget, you can create opportunities to save more money and build more wealth. So that's really what they should be focusing on, is simply just having a budget.
And just our everyday financial habits.
But it's not. I gotta chime in there. It's not just about having a budget. It's about inside of that budget creating more efficiency and getting your dollars to go further for you, right? Like what I showed here. It's not about just paying cash or not doing it. It's about, if I'm going to do this thing because I want to expand my business, I can either pay the bank that interest, or I can pay an insurance company and strategize that way, because you're not eliminating the interest expense. But the question is, how do you keep your money growing at the same time? That creates a level of efficiency, right? That you wouldn't have otherwise. And that's the system that they're talking about. And in defense of them, this is a long time ago. I bet you if they were to look at this video themselves at this point and redo this video, there are probably a lot of things they do differently because they've evolved a lot. I should probably get them on the channel and talk to them about this and have a conversation with them. That'd be fun. But my guess is, they would do this differently this time around, and they would probably communicate differently. They've evolved, they've gotten better, and he just needs to, I think he just doesn't understand.
How much money are you spending? That's going to be gone forever. It's going to be gone forever. Can we be maybe reorganizing our finances in a certain way that will benefit us to keep more of our money?
Yeah, because let's think about what's really easy for us to do. It's really easy for us to spend money because we have all these reminders and notifications of when our bills are due. Mm-hmm. Why don't we have that same thing for our savings? Why don't we have that same thing for paying ourselves first?
All right. So they don't understand what they're talking about. So what they're referring to is payment reminders, right? Payment reminders are a good thing. Payment reminders is a tool that can be used to make sure that you're not paying your bills late. Because when you pay your bills late, you also incur an extra fee on top of whatever you were supposed to pay. So let's say I have a minimal credit card payment of $50, right? The credit card company, maybe the app that I have on my phone, reminds me a few days, let's say about a week or a couple of days before that payment is due. Hey, you have a $50 credit card payment. Make sure you make this payment before or on the payment date, right? I make the payment, everything's good. If I forget to make the payment or I make the payment late, not only do I have to pay the $50, I also have to pay a $25 late fee. And that late fee doesn't go towards paying down my balance. That goes straight to the credit card company. So it's actually a benefit to the consumer. It's a benefit to the end user for these payment reminders. It's not a bad thing. So for them to frame payment reminders as some kind of bad thing shows that, one, either they don't understand how finances actually work, right? Which is a very strong
Okay, now he's stretching it. Like, they didn't say payment reminders were bad. They were saying there was nothing that I took out of that made me think that they were saying payment reminders were bad. What I got out of what they said was, if they do that for that and it's good, why not do that for our savings? That's it. That's what they said. And he took it and made it into something like, now he's getting like overly critical. And to me, that's kind of ridiculous.
Possibility. Or two, this is a grift, and they are framing payment reminders as a bad thing when actually they are a good thing. Remember? No,
they're not framing it as a bad thing. They're actually probably saying payment reminders are good. And so therefore, why don't we get reminders to actually save money and have that? It's the old adage, the telephone that rings gets answered, right? The squeaky wheel gets oiled, like these kinds of things. And so we don't get reminders to save, to invest, to do these things. We have to be proactive about that. That's one of the reasons people struggle. People pay their bills because they get reminders. So why don't we have a reminder to save money? And one of the things that they're leading to, that he obviously, this just shows, it's another example. It shows he doesn't understand this. What they're saying is that when you save money in a whole life policy, the way that we do, you're going to get better returns in a bank. You're going to have a little bit of a crunch with liquidity on the front end, even though if they didn't say that right now, that is what it is. But that premium deposit that you have is going to be the effective nature of a payment reminder, of a savings reminder, to be able to do that, because you're going to have that requirement every single month. And sure, there are ways you could structure it to create more flexibility, but that is the function of what we're talking about with this. And so he's trying to make it sound like they don't know what they're talking about and everything. He totally misinterpreted what they were even saying. And he got super emotional about it, which is kind of ridiculous.
I mean, we live in an age where everyone has a computer in their pocket, right? But I was born in '83, and y'all probably are tired of hearing that. I just like to say the date that I was born. But I'm an 80s baby. I remember when there wasn't a whole lot of payment reminders. My parents are business owners. I remember that they had to be their own internal payment reminder. They had to mark on calendars when certain bills were due. Then they had to pull out their checkbook, write a check, put it in an envelope, address it, put a stamp on it, and send it out, and make sure that that payment got to whatever vendor that they were paying in time, so it was not late. All that responsibility was on them to do. Now we live in a technological age where you can get a text message or an email reminding you to make the payment. You can set up the payments to be automatically withdrawn from your account, so you never miss a payment, or you're never late on a payment. So you don't incur the extra fee that the vendor, the bank, whoever charges you. So the payment reminder is a good thing. It's not a bad thing. Then they ask the question, well, why isn't there payment reminders for you to save your money? There is payment reminders. You can set up payment reminders to save your money. You can go to the bank and you can tell the bank, hey, on the 1st of the month, the 15th of the month, whenever, I want $300 to be transferred from my checking account to my savings account every month, no matter what, unless I tell you differently. The bank will do that, right?
And there are apps that can do it for you as well. Like that, I mean, there are ways to do it, but it takes a proactive process and a proactive mindset to do it. Like that's it's not just going to happen because you need to do it. It's not just going to happen. That's all.
About at your job, right? If you have a job that has certain benefits and a retirement account is one of those benefits, and you set up, your 401k plan, and you say you want 5% of your pay to go into your 401k.
Yeah, but that's not saving. If you want to put money in a 401k, this is okay. I want to hear him out. Hold on.
K plan, which is a retirement savings account that is invested.
No, it is not. It's not a retirement savings. He said it's a retirement savings account that is invested. It's a retirement investment account. Savings, there's no risk. Investment, there's risk. And so you can't say that a 401k is a savings account because nobody's saving. I mean, I guess if you want to go and put it in a money market account or something like that, you could. But at the end of the day, now you have all the taxes and the government, and I'm just not a big fan of 401ks. And so there's probably a wide gap in my values and beliefs between his values and beliefs. And I bet you I'm more in alignment with the Wealth Nation people with their values and beliefs about what we want to do with our money. And I don't want to give my money into a 401k. I've never put money into a 401k. I never will. I'm successful. You don't need to put money in a 401k to be successful. That's just kind of a broken mindset. In fact, I would argue ever since 401ks were created in 1981, when they became mainstream, more people have struggled with their retirement planning than ever before. And a lot of that is because 401ks have been a ripoff. And go back and look at the 60 Minutes 401k scam video, all these things. So many people have been ripped off with 401ks over the years, yet he's just acting like somehow all these accountants love it because it just makes them seem really good. It's like, hey, I can reduce your taxable income. You're getting a tax deferral, not a tax deduction. Sure, you get to deduct it from your income this year. But if you think taxes are going up, which most Americans do, why defer taxes today when you're going to pay more later?
Those are automatic things. So I smell a grift coming because there's simple ways that you can set up.
I need to understand what this grift thing is.
Payment reminders for savings, just the same as there's payment reminders for your debt. And once again, payment reminders is not a bad thing for your debt. It's actually a good thing. So either they don't know what they're talking about or a grift is coming somewhere.
Because that doesn't help the people who you are giving your money to. It's best if you don't understand your finances, because then you'll rely on someone else. The person you rely on is who is going to benefit the most from your hard work.
Yes, and Darius just came up with this breakthrough, which is amazing because, again, we get the reminders all the time, pay your minimum payment, or, oh, now you have 2,000 points because you spent $3,000 or whatever it is. It's sexy. There's more engagement in your credit accounts, for example. But the bank is not calling you to say, hey, it's been the 10th, Darius, you didn't put your deposit in the savings account.
You can set up, the bank's not going to do that automatically. You have to tell them that that's what you want done. But if you tell them that, they will do it. You can tell the bank that you want that money to be transferred. Hell, I've got a checking account with the bank where I told them, I want you to round up every transaction. So if I buy something for $1.50, I want you to round up to $2, and I want the 50 cents to go into my savings account. That means every transaction that I make out of that checking account it's going to round up to the nearest dollar. So if I spend $1.10, it's going to round up to $2.90 goes into my savings account. These things are possible. Now, if you're unaware of them, that's why this channel is here, right? I'm helping you think.
There are apps that do that. I use Acorns and it does that. It works
like an accountant, but they're framing it as if it doesn't exist. So either they don't know or a grift is coming.
And the reason why? Because you don't have to. Because they'd rather you use your credit card and pay them interest time and time again.
Yeah, because they'll rather be able to keep more money in their business than money going out. And by you saving money, it's a small amount of interest, but it costs them more money in your savings account than it does in your checking account. So by you saving more money, it costs them more money. Now, when you
No.
Yeah.
They don't know what they're talking about. They don't.
When you put money in a savings account, you get a higher interest rate than when you have money in a checking account. Therefore, it costs the bank more money. That's a fact. So they're not the banks are certainly not incentivized to do it, but they will do it if you ask them to.
Know how the banking system works. So here's a quick breakdown of why a bank is going to pay you more interest in a savings account than not paying you any interest in a checking account. I'm gonna try to make it as simple as possible. So banks make most of their money by lending money to people and charging them interest. That's how banks make most of their money. A bank has the ability to lend money based on how much money they have in their bank as a deposit. So here's an example. Let's say I deposit $1,000 into a bank, and that bank can lend up to 75% of the deposits that the bank has. Now, these rates are going to be based on what the Federal Reserve says that they can do, but I'm going to use 75% for this example. So if I give the bank $1,000, that means now the bank has the ability to lend an additional $750 because I made a deposit of $1,000. So for a bank, the more money it has in deposits means the more money they can lend out to make money from interest on those loans. So it's actually the opposite of what this guy just said. The bank would prefer you to keep as much money in the bank as possible so that it can then lend.
But it doesn't matter if the money is in your account. If it's in the bank's balance sheet, which whether it's savings or checking, it's there. Yeah, they want you to hold on to it, but that doesn't mean. I mean, I made a mistake the other day. I was looking at one of my credit union accounts, and I have a savings account that has 4.5% interest rate right now. And I looked in it. I hadn't checked on this account in, I don't know, God knows how long. And I looked in it, and the checking account was like some old checking account that I had from like 8 years ago when I was living in Vermont, and I still had this thing. And I looked at it, it had like $4,800 in it, but it was sitting in the checking account, not the savings account. So that $4,800 is an asset on the balance sheet of the, or I guess a liability technically, according to the bank technical terms, but they are able to leverage that. Or if I had it in the savings account, I was going to be earning money the whole time.
Lend more money out. So
4%,
why is a savings account paying interest while a checking account is not? Well, a checking account is an account where there's going to be a lot of transactions. It's going to be so many transactions where the bank really doesn't have a nice foundation of how much of deposits you're going to have, right? So you can have $5,000 deposited in your checking account one day.
It's still there.
Then you pay all your bills.
They still look at the balance. Like they're not looking at your individual account, guys. I got news for you. They're not looking at your account. They're looking at the overall money of deposits. You got to know that the bank has the overall view of the total deposits in checking accounts, saving accounts, money market accounts, all these different types of accounts. They have that overview. They have it. Okay. So it doesn't matter how much you're moving money. They're actually making more money with transaction fees, with all sorts of different overdraft fees and all these things on checking accounts. If you break it down like that, checking accounts are actually more profitable than savings accounts in the way he's talking about. That's how they make that money. What he's saying is absolutely not correct right now.
And then now the account's all the way down to $1,500. While with the savings account, the bank can basically tell you, hey, you can open up this savings account and we want a bare minimum of $5,000 in the savings account. And we want you to keep your transactions down to about 5 transactions a month as far as taking money out, right? 5 transactions a month. If you go over that amount of transactions, then you might get hit with a penalty. You might not be able to get the full amount of interest for that month because you broke the contract. We said keep it to 5 transactions. You did 8 transactions. We were paying you 1%, but now we're not going to give you 1% for that month because you did too many transactions, right? Why? Because the bank wants to encourage you to keep as much money in the bank as possible because the bank can lend more money based on its deposits. That's the very basic way banks make money. So
he's not wrong, and it doesn't matter what account they're in, like I said. And so they have a total view. In the savings accounts, sure, they have it set up where they give you a little bit more, it costs you a little bit more. But the bottom line is you can keep that money in your checking account and it's still an asset, the same apples to apples asset on the balance sheet. Do they have as much clarity with your specific account? Nope. But they're not looking at your account. If they look at in the entire behavior of everybody in the bank, they have a pattern that they're able to see what the balance is, you know, for their total checking account balance, what the balance is for the total savings account balance. And then they also have the profitability for the checking account balance, or for the checking account profitability of that business entity, a kind of silo of the banking business, from overdraft fees and other checking fees, the $12 a month checking account fees that people get for not maintaining high enough balances. He didn't mention that most people don't have enough money to keep their money in an account without getting charged a 12% monthly fee. You know, so they're getting charged a lot more in the checking accounts than they are savings accounts. So what he's saying is just totally not true. It's totally like he's just doing what all these other people do, and he's kind of pigeonholing and cherry picking ideas and concepts and, you know, facts that he wants to share, and he's not sharing all of it. And so just, yeah, I don't know.
For him to say that a bank doesn't want you to have money in a savings account is ridiculous. He has no idea what.
I agree. It's not that they don't want you to, but they prefer it. At the end of the day, I don't think the bank cares, and I don't think the answer is the same for every bank. I think there's probably different structures for different banks.
Talking about. I mean, we haven't even gotten into the point of what infinite banking is. And just a little bit of background, because I'm a financial planner, I went through a program that's registered with the CFP board, the Certified Financial Planning Board. They basically, you know, set the requirements of what a financial planner's education needs to be. And within that education, those books right here, all those books there, you learn about.
Read some books. Good for him.
These different financial products. You learn about what infinite banking is. I already know what it is, but I want to see how they present it to.
CFP does not talk about infinite banking per se at all.
The public. So they haven't even got to the point of what infinite banking is yet. I know what it is, but I want to see how they present it.
You spend money, which means you borrow some of their money. That means you are making them more money. So their business is growing because they're able to keep more money. Now, if we.
Yeah, he's confused. Yes, a bank is going to make money, right? Pay attention. The bank is going to make money if they're lending you money in the form of credit on a credit card, right? And you're late on making a payment, there's a fee there, or you carry a balance from 1 month to the next month. They make money off the interest that they're charging you for that loan. But that loan was a benefit to you. But for whatever reason, you didn't have the available cash to pay for whatever product or service that you wanted. So the bank lended you money, right? So that you can make the purchase that you wanted. Otherwise, you wouldn't have been able to buy whatever it is that you wanted, right? Or you made a strategic decision not to use the cash that you had available. You wanted to use borrowed money. Okay, well, there's a cost to borrowing money.
Sure.
And that cost is interest. He's making it seem as if the bank is some sort.
Yeah, but what they're saying and what he's missing is that the bank will pay you in this year he was talking about. It was 3 years ago. Interest rates were much lower. The bank would pay you 1%. And if they're going to, if I put $10,000 into a bank and I get paid 1% in a savings account on that, 1% of $10,000 is $100. Okay, so think about it. So I'm making $100 to deposit my money. That is the benefit to me. Now the bank is going to turn around because it's a tier 1 asset on the balance sheet. They're able to turn around, and now today with the Fed's rules, they can lend 100% of my money out. Okay, so they can lend 100% of that money out. What are they going to do? They're going to charge, say, 7 or 8%. So they're going to charge 7 or 8% and make $800, right? And so what is that? What does that return? They pay me 100, they make 800. That's a $700 profit. That's a 700% return on their money. That's how the banks make money. This is what these guys are trying to talk about. That, you know, he's saying they don't understand. They're not articulating it the best, and I'm sure they've gotten better once again over the years in doing so. But he's once again just kind of misrepresenting.
Boogeyman that really doesn't exist. If you made the adult decision to borrow money to make a purchase, then yeah.
And it's not saying that they're making the banks the boogeyman. They're simply saying what I showed you on the board. If you could pay the insurance company and still have your money growing at the same time, that's what they're saying. It's not some big conspiracy theory. It's just math, bro.
You're going to have to pay for that loan. But if you paid it with a credit card and you paid off the credit card before the close of that month or that billing cycle, you basically had an interest-free loan. but you just have to be responsible, and most people aren't responsible. They're carrying a balance month to month. So that's,
you get all
does the bank take advantage of the fact that most people aren't responsible and they don't pay off their balance before the end of the billing cycle? Absolutely. That's the world that we live in. I don't know who went around telling people that the world is fair. I never got that lecture. No one taught me that the world was fair. So I don't understand why people believe the world should be fair. You're in a marketplace. A marketplace is a competitive situation, and in competition, everyone doesn't win. In competition, there's winners and there's losers. How do you make sure that you're on the winning side? How can you try to increase your probability of being on the winning side? You have to prepare yourself. You have to practice. You have to get the information that you need to make sure that you have a higher probability of being on the winning side.
I don't like how he's like taking this and twisting it, and he's like not even taking what they're saying and like staying on topic or relevant. He's just kind of going off and like using it for his own soapbox about things that aren't even relevant to a reaction for this video.
Of the situation and not the losing side.
We start positioning ourselves and start thinking that exact same way, then maybe we'll start taking more action, saving money and paying ourselves first, because the risk associated with paying ourselves first is minimum zero in comparison to when it comes to borrowing money that we don't have.
Yes. Now, when Darius said that it costs the bank more money to keep our money, it's because they have to pay us interest, right? So if you put your money in this.
No. I just explained this. The reason why the bank is paying you that interest is to incentivize you, to give you a reason to keep more of your money in their deposits so that they can lend more money out. That's why, man. It's simple business dynamics. I have to give you an incentive of keeping your money in this bank account. So I'm going to pay you interest. I'm going to pay you less interest than I'm making off lending your money, because that's how businesses work, right? You need to make sure you have more money coming in than you have going out, right? But once again, putting your money into a savings account or a checking account is not an investment. There's no risk of your principal. You have $250,000 worth of insurance on your bank deposits. So if you lend the bank $100,000, right? You lend the bank $100,000 based on the 75% lending ratio that I'm giving for this example, they can lend $75,000 out to someone. Yep. What happens when that person doesn't pay the bank the money back? Something happens and they're unable to pay the bank the $75,000 back.
If you think the bank doesn't have all like equations to make up for all that and to account for the interest rates that they're lending at, like, come on, man, like, you know better than that. They're going to charge if I in this example that I was giving at 100,000, I'd make 1,000. The bank would make 8,000 at an 8% interest rate. Well, let's say they have a certain default rate and they take 2 of that percent. 25% of the 8% would be 2%. So they take 25% of their profit and they allocate it to a place that says, all right, in case of defaults, we're going to put this over here. They're still making 6% net minus the 1%. That's 5%. That's $5,000 on $1,000 expense of holding that money, which is the money that I'm getting paid for the interest. And so they're making a 500% return on that money, net after everything. He's trying to make it sound like that's not, like, once again, if you compare it to what I was talking about before earlier in the video, if you could eliminate that expense in your life in the borrowing cost and how you behave with your money and take advantage of making purchases, borrowing money, making major capital decisions, this is where he's kind of missing the boat.
What happens to my account? Nothing happens to my account. I still have $100,000 in my account. Even if the bank goes bankrupt, they go out of business because they lent a whole lot of money out to people who didn't pay their money back. If I have $250,000 or less in that account, the federal government will pay me my money and I will not lose a dime in the situation. So you got to understand how banking works. They're setting it up like banks are some sort of crooks. Banks take advantage of people who don't know how to budget and they borrow a lot of money on credit cards for personal use and luxury items. If you're borrowing money, you need to be borrowing money to finance investments, be it investments in maybe real estate or investment even in yourself for student loans. It should be financing something that's going to make you more money than the interest of actually taking on the loan, right? That's how it should work.
Savings account, although the banks these days aren't paying much money, they still have to pay you a certain amount of interest for keeping your money in the savings account. Whereas on the contrary, if you use a debit or if you use a credit card, you're going to make money for the banks because you have to not only pay the principal back, but you have to pay the interest.
No, the bank makes money regardless. The bank is going to make money if you keep your money in a savings account because they can lend the money out. And if you use their credit card and you carry a balance from month to month, or you have late fees, they're going to make money. So the bank situated itself to make money. But if you are fiscally disciplined, you can leverage the bank so that you can use their money in a credit card, right? Where it's minimal to no fees and you're borrowing money but paying it on time, where you're not getting charged any real fees, but yet you still had the use of their money. So that it's they don't know what they're talking about, and they haven't even got into what infinite banking is yet.
Keep talking about
so that's the difference, and that's why there's more emphasis on credit and having all these amazing cards with these points.
Right, we got it.
Banks are going to make money, and that's why savings accounts aren't advertised. When is the last time you've seen an advertisement for savings account?
I was thinking, I've never seen that.
You don't know what you're talking about, man. Anytime I have ever opened up a checking account, the bank teller has always asked, would you like to also set up a savings account? Like, they don't know what they're talking about. The savings accounts are always pushed because that's where the bank has some security of knowing how much money they're going to have in deposits so that they can lend more money out. So they don't know what they're talking about, and we still haven't gotten to what infinite banking is. I'm going to have to do some skipping here.
Commercial saying, save your money, pay yourself first.
Yeah, I was like, I've never seen a savings commercial. If you have, let us know. So anyways, going back to the point I was trying to make is it's always going to be the emphasis on the debt versus the savings.
Okay, whole life insurance.
All right, here we go.
So where else can we store our money where it doesn't necessarily have to be in a bank, but we can still reap rewards that are greater than what's right around the corner?
Yeah, and that for us is life insurance. Yeah. Now, okay, whole life insurance, more specifically from a mutual insurance company.
All right, so here's the grift. Here is the infinite banking and how all of that works, right? So they're talking about not using the bank to save your money, not putting your money in a bank as a deposit. They're saying you should take the money that a normal person would use to save in a bank. They're saying, no, put that money into a life insurance policy. Understand there is a major there's a major difference between a bank and an insurance company. When I put my money into a bank, it's still my money. I can take the money out, use it however I want. It's my money. Putting money into a life insurance policy, you're actually buying a product. You're buying something, right? It's not the same.
Yeah, you are buying something, and you're buying something that's going to provide a lot of value. So, I mean, I've got a lot of videos that will cover this topic on the different value and the different problems that life insurance and this $1 will solve for you. But I'm interested to see what he says. Like, he's being very, very myopic on this one little topic, and his energy around it kind of drives me nuts.
But let's see how they explain it.
And the reason why we utilize tools from a mutual insurance company is because of the fact that we get to benefit from the dividends and the growth in our policy. We don't have to pay taxes on it for a second time. So that is an amazing tool that we can utilize.
All right, so let's. All right, let me try to explain. So what he talked about with dividends. Okay, so there's two ways that an insurance company can have ownership, right? You can have an insurance company that is owned because it's a corporation and it's owned by stockholders, right? Yep. People who bought stock into this insurance company, they are the owners. And what happens is when that company makes money and has profits, it can then pay out those profits to the owners in the form of a dividend, right? So you own a piece of a big insurance company. The insurance company makes a profit. It then distributes those profits to the owners in the form of a dividend. That is how a stock-owned company works. What they're talking about is a mutual company. How does that work? A mutual company is owned by the customers, right? So if you are a customer of the mutual company, you're also technically a owner of the company. So that company can make a profit also. But the question you need to ask yourself is, where is the company making the profit from? If all the owners are also the customers, it means that the profit comes from overcharging you.
So all right. Okay, I'm gonna hear him say this out, and then I'm gonna blow his whole argument up.
The customer. So the reason why a dividend from a mutual company is not taxable is because the IRS understands that this isn't new money. This is really just a refund from a portion of the policy that you already paid the company, right? Let me try to break it down. If I'm getting paid, let's say I own stock in Apple, right? I own stock in Apple, and I'm also a customer, right? I have, an iPhone, right? But there's a lot of other people who buy products from Apple that aren't also an owner in the company. So when Apple makes a profit, it can distribute that profit to the owners, who are people who might own Apple products or might not own Apple products. I still get a dividend no matter what. This is new money to me, right? But if I'm a member of a company whose all the customers are also partners or shareholders in the company, that means the profit that company makes comes solely from the owners. So it's not like you're getting new money. Now, if you were to get new money, right? If you were to receive more money back from a dividend from this mutual company, then you actually put money in, that would be taxable. So the only reason why it's not taxable is because it's viewed as a refund of money you already paid in. It's not new money. I hope that made sense.
That makes total sense. And I'm glad he put it that way, because it's actually going to ruin his argument. And so because you put your money in that way, it's viewed as that. And so you get the tax benefit of that. And if you go back to 1913 with the institution of the Federal Reserve, and you look at the people that had all their money in whole life insurance before that period, and then they create the banking system, people put their money in the banking system. The people that run the banks had their money in whole life insurance. If you go look around right now, life insurance, there's more life insurance held by banks on the as a tier 1 asset on the balance sheet than any other institutions in the world. So we put our money into banks, and a lot of banks keep their money in whole life insurance. That's just a fact. That's not negotiable. You can go online, look up how much money. Go do it yourself. I'm not even going to show you an image. Go to Google after you're done this. Open another tab while you're listening and Google how much life insurance do life insurance companies carry on the balance sheet as a tier 1 asset. Go do it. Go do it. Do your own research. Do your due diligence, and you'll see what I'm talking about. Now, from there, he's saying life insurance, the dividend is a repayment. It's a refund of overpayment of premium. Okay, that's what he's saying it is. So if that's the case, if I paid in $1,000 a month or maybe a year of a policy, and then out of that policy, my insurance charges are whatever they are. And then I have, out of whatever my insurance charges are, let's say my insurance charges are $400, okay? And out of that $400, I get 5% back, right? So that'd be what, 20 bucks on the $400 insurance charge? So it's a refunding of overpayment of premium. It would be impossible for me to ever have more money in my cash value than I paid into premium. From a technical perspective, he's not wrong. The IRS looks at it exactly like he said. So he's not wrong, but these are the kinds of loopholes in the world that people take advantage of when they understand it. Take advantage of the way the tax law is written to your benefit, but understand that life doesn't actually work like that. The money doesn't actually behave like that into the policy, because if he was right, that would be what it is. So now I want to show you, I'm going to show you this. I want to go here. I'm going to go back to my board, and I'm going to go to I have all this content that I do, and I'm going to scroll down. I'm sure I got an illustration here. I want to find a reasonable illustration that's something I could show for this that I think would be good. Would it be here? Nope. I will find it. I promise. This might be good. I don't know. I've got this all marked up, so we'll see. We'll see. Yeah, so this is actually a really good example here. Let's do this. So I'm going to just focus on this right here for you. And so if you look at this, this is basically taking right here, and I'm going to use this green pen. You're taking a 40-year-old male, standard non-tobacco. We're using a 20-year term rider just to show this. And so this is, when we're talking about, this is what these guys are saying about a $10,000 premium. Let's say you were saving $10,000 a year in the bank. There's a cost for this, okay? There's no doubt. I'm not going to get around that. I'm not going to even spend a lot of time on this because you're losing liquidity year 1, right? But by year 10, you got $13,000. You have $106,000, and you've paid in $100,000 of premium. So you're ahead on your account. Now, what he's saying is that it's a return of premium. So in the sense here, if we're only getting the dividend back as a portion of the overpayment in premium, well, then it would mean we'd never be able to have more net cash value than we paid in contract premium. And you can see here by year 20, in this situation, a 40-year-old starts off at year 20, right? And I'm going to go to this so I don't mark it all up too much. We paid $200,000 of cash value right here. We have $276,000 of net access. Now, if we want to scale out what we were talking about earlier, and we look at that number, and we stay focused on these numbers right here, right? And we said, all right, now I want to access 200,000. Well, I could borrow against it. I could take this. I could go buy real estate, right? And I could use this as a down payment or whatever on a couple properties or whatever. And I could go get it. And I don't know about you, but what's the cost of capital? If I could get a loan at 5.5% right now as a down payment for a real estate property in today's economic environment, this cost of capital saving is so powerful in a world that you're going to have to pay cash, or you're going to have to, go and buy a rental property at 8.5% or maybe 8%. The savings of cost of capital just by having your money in this policy is well worth the little capital crunch that you had back in these days, right? But this is what I'm saying. This guy's an accountant, but he's not an entrepreneur. He doesn't understand this stuff. He's never, run this or done real estate is my guess, because if he did, he would understand this, or he'd at least be asking himself different questions. He's acting like, because he took a CFP, he understands this stuff. And he said, I took the CFP, I know about infinite banking. They don't teach infinite banking or anything of this nature in the CFP. And so when we look at this, we could then borrow against it. We're going to say pay this 5.5%. So it's going to be $11,000 of interest expense. Okay, cool. So you're going to have this $11,000 of interest expense. But meanwhile, this money's going to grow. And by the time you pay it back, it's going and let's say you pay it back at the end of year one, you pay back that $200,000 loan. That $200,000 is going to come off of this 276. So that 276 is only going to have 76,000-ish collateral capacity at the end of it, right? That's how much more you could borrow. That's why I call it collateral capacity. And if let's just, in this vacuum, say that you paid this $11,000 interest expense, and that was your expense. At the end of the year, if you're earning a 5.5% dividend, it's 5.2% right now. You're at 5.2%, you would have $210,400, right? Is what you would have, keeping it really, really simple. And so your really net interest expense at the end of it all would be much less, right? If not a break even. But the power of keeping compounding going of this money is really what this is about. The power of keeping the cost of capital controlled is what this is about. It's interesting. Entrepreneurs and real estate investors get the value of this. Accountants sometimes have a hard time wrapping their head around. I will debate this guy anytime live about this and wipe the floor with him. So anytime you want to talk, let's go.
And a lot of people haven't thought about utilizing the tool because why? We've been conditioned to utilize the banks. Also, there's people that say, well, why not put the money in term and invest the difference?
Right.
We're not talking about investing.
We're not talking about investing. We're talking about saving money.
Yes.
No. But you can do the same thing, right? So if I've got a term policy that costs me $50 a month for, let's say, $1 million policy, and then you have someone that has a whole life policy that's charging them $600 a month, I can simply, we got the same coverage. The only difference is my coverage is for 30 years and their coverage is forever, right? It keeps going until the day they die. They're going to continue to pay premiums.
I'm going to show you something here in a second.
The big difference here is I can take the extra $550 and I can invest some of that money, or I can save some of that money into a bank or credit union, wherever. And I have access to that money whenever I want because it's my money, right? In their situation, yeah, they got the same insurance coverage that I have, but they're paying a lot more money. Now, a portion of the money that they're paying in is going to a separate account that we will refer to as the cash value of the account, but I don't have free access to that money, right?
No.
The best thing I can do is borrow from that money.
Yeah,
and I don't even get to borrow 100% of that money. I'm only able to borrow the portion of my premium that actually went towards the cash value. Then out of that cash value, there's only a certain percentage of the money that I can borrow. So it's like I have to borrow from.
That's not accurate at all. You have access to about 90 to 95% of the cash value in the policy. That's it. It has nothing to do with the amount of premium you've put in. It's just what's the cash value.
My own money that I have to then pay interest to the.
I'm going to get to the buy term and invest the difference fight back or push back in a second.
Insurance company to borrow my own money, and I can't borrow 100% of my money. I can only borrow a certain fraction of the money that I already paid. It's they don't know what they're talking about.
They actually know more about what they're talking about than you do. That's the challenge. But that said, let's do this. I'm going to go here. I'm going to expand my screen, and I'm going to share this. So this is what I want to show. I want to work on this a little bit. So when we talk about buy term and invest the difference, this is going to be a really, really eye-opening thing. So the idea would be like a buy term and invest the difference. You can see a 25-year-old here. You can see I got a 35-year-old, a 45-year-old, 55-year-old, and 65-year-old. So this is saying for people, and I think this is going to be a real clear picture for you. So this is showing $12,000 a year premium, and you can see every year, every contract, 25, 35, 45, 55, 65, $12,000 a year premium. So when we look at $12,000 a year, the question is, why would I put all this money into a whole life contract when I'm only picking up $242,000 death benefit when $12,000 a year of premium into a term policy could be way, way more, millions of dollars, right? And so, but we're looking at this, we look at, okay, by the year 10, right, we got $120,000 of premium, $134,000 in net cash value that we can leverage, okay? This money, whatever you're looking at in this column, whatever he's saying, it has nothing to do with how much premium we've paid. It has to do with what's the net cash value. We get about 90 to 95% access of that money at all times, okay? Also, we have this death benefit that's going to constantly be growing, okay? So his idea would be saying, well, you're 25, you don't even need life insurance, so why do it? Well, life insurance is never going to be more affordable than it is today. You're probably not going to need 242, but guess what? Look at this. It keeps growing. By the time he hits 58 years old, he got $1.1 million and $715,000 of cash value, even though you only put $318,000 of premium in. That's a pretty darn good savings account when we start thinking about all the different ways that this can get to, all the different ways that this can benefit you. And so there's a couple of things I want to show you when we start talking about term. A, what's the cost of waiting? Cost of waiting for the 12,000 is, you see next year, let's go down from 25 to 35. There's actually a little bump here in the death benefit, which is kind of cool. The cash value at year 10, 134 to 133. So it goes down because the cost of insurance is a little more high. At 45 years old, you get less death benefit because now we're start talking the risk, the mortality charges and expenses that come into it. At $12,000 premium at 55 only gets you 176, and at 65 it only gets you 116. So your death benefit goes way down. The liquidity from year one, if you structure this the right way, is okay, but like you could see at year 10 is where it starts impacting. Like you put in 100 or so. Oh yeah, in this one, year 10, it's because we're funding it at a smaller level. We funded at 100,000. We only have 108, right? And so that's because we had to use a different rider, because the older person is just going to be more expensive if we insure it for too long. And so, but here's the deal. This is what he's saying. Let's use, I'm going to go back to here. I'm going to go back to a 45-year-old, and let's say, or a 35-year-old. Let's say a 35-year-old just had kids, had a family. So somebody would say, get a 20-year term. Somebody like JT would say, get a 20-year term right here. Just do this 20-year term and get maybe a couple $1 million of life insurance and knock it out while you have it, and why you need it. And after this point in time, once you're 55, the kids are going to be grown and gone. You're going to be able to self-insure. You're not going to really need anything else. And so you could see here that if he did that, and let's just say, well, they probably have other needs during retirement. There's a lot of studies out there that show that whole life insurance, this is not an investment, it's a bond alternative. And if you look at the 60-40 bond portfolio in retirement, it's dead. People have been getting massacred. Whole life insurance is going to provide you basically bond-like returns, and it's a bond alternative, and it's going to do that with a lower standard deviation, basically providing better results for you in retirement as a volatility buffer, helping to eliminate your sequence of return risk. This is all, once again, just stuff that may be above his head, even though he took a CFP. I don't know. But the bottom line is, when we look at this person, the odds of them getting sick, the odds of them needing more money, like having a bond portion of the portfolio. Once again, I'm not saying do everything in here, but not having any money in here is just not financially optimal. That's just the way it is. And so when we look at, this 45-year-old, when they get to 65 years old, if they just did this, they'd have $282,000 of premiums, $578,000 of cash value. They could use this as the bond portion of the portfolio. And in using this capital through withdrawals up to basis, because they can take up to $282,000. You don't need to access this all as policy loans. So if we're using it as a volatility buffer, we're not using policy loans. We're doing withdrawals and partial surrenders up to cost basis. So $282,000 is completely tax-free. So that would leave about almost $300,000 that then you would want to use policy loans, and it would all be guaranteed by that $849,000 death benefit, okay? So now if you did surrender and withdrawals, this death benefit would go down accordingly. So with the cash value, you just gotta look at that. But this is something that would be there to help reduce sequence of return risk. Guy named Dr. Wade Fowle did a study on this, and he showed simply by having whole life insurance in your retirement portfolio and doing what I'm talking about is gonna put you in a position where your investments are gonna be able to earn 25 to 50% higher returns than they would without it, because you have this to lean on negative years, so you don't have to withdraw or draw down negatively performing assets. That's what's going to kill people, right? You can have down years when you're not having to tap into the money and when you're able to just let it recover, but when you have to withdraw money from negatively performing assets, that's where the wheels come off of people's retirement plans, and sequence of return risk and longevity risk, meaning the longer you live, it's an amplifier of all risk because you need your money to last longer, and it increases your chances of going through down economies. And so all this is stuff that you need to take into consideration. And so now we look at this and we go, okay, let's just say you invested the difference, right? But the bottom line is you have different needs. Is it fair to say that when you get into retirement, you have this need for the volatility buffer? Like I said, okay, that's great. We have it. It's there. Is it fair to say that if we go to the next thing here, that you're going to need living benefits, meaning there's a chance that you're going to get sick? I'm going to go to the next one here. I've got them all here. No, I got to go to the next one. This is just the premium. I just did this whole thing for a report here. For a thing that I was doing. So now we can see here the accelerated death benefit report. Okay. So for this, and I cut that off, but that's what this is. You can see all this stuff is the same. So you can see chronic. If you become chronically, critically, or terminally ill, you have access to these benefits. And so I'm going to zoom in on the 45-year-old here. Okay. And when we look at this, while we're in our 60s and 70s and 80s and during retirement, you have access to this money if you become chronically ill, diabetes. You lose 2 of 6 daily living activities, long-term care alternative, cognitive impairment, terminal illness. You get diagnosed with a cancer. You have access to the death benefit while you're alive, and you can get access to this money while you're alive. If you do his buy term and invested difference, 70% of bankruptcies in retirement are due to medical issues because Medicare, Medicaid is not sufficient enough. Your deductibles for a lot of the illnesses that are going to happen are going to be horrible. And not only that, when you actually need to go and pay for stuff, or like if you get sick, I share the story of my father-in-law diagnosed with stage 4 pancreatic cancer. He went in with a twisted ankle. They found a blood clot. The blood clot went to his groin. They scanned his groin. They found a 7.5 centimeter tumor on his pancreas that had spread to his liver. Okay. They gave him 90 days to live at the hospital. And we went through this and we were able to accelerate his life insurance. And because of that, he was able to have multiple 6 figures to be able to do alternative medical treatments, because they basically said, we could help you. We could give you chemo and radiation, but we're going to have to give you such high doses that the cancer is not going to kill you. Probably the radiation is going to kill you before the cancer does, right? And so we're like, well, that's stupid. That doesn't make any sense. And that's no quality of life. And he refused to do that. So we looked for alternative treatments. It was November 4th, 2020, when he was diagnosed with that. He is still alive today. And the day I'm filming this, I think it's like May 15th, 2024. So we're looking 3.5 years, almost 4 years now, that my father-in-law has had pancreatic cancer. He's been living with it, all because he was able to accelerate this and look for alternative treatments that health insurance would not pay for in retirement. I don't know about you, but to me, that's an extremely valuable benefit that when you look at just the buy term and invested difference mindset, they're missing the total value. And it's like they're trying to fill in their own conversation about what they're trying to accomplish. And they obviously have their own agenda of what they're trying to preach. And it literally drives me crazy when people talk about stuff that they don't understand. And so anyway, let's get back to it. Hopefully that helped.
We put our money in term, about 2% of the population.
Notice how I'm actually trying to teach you something and not just rip people apart, though.
You actually utilize term, and then you want to wait until you actually have money when you're in your 50s, 60s, or 70s, where you can't even buy insurance to pass it on to the next generation.
When you say utilize, he means die. 2% of the population has to die in order for term insurance to pay out.
Yeah, term insurance is very cheap to the insurance company. It's also a cash cow. So if I had an insurance company, I would tell you to buy term, but I don't have an insurance company.
No.
So I'm telling you to buy what you should.
All right, that's the grift. that's part of the grift. The thing is, these guys, they're insurance agents. They've got to be.
Yeah, they are insurance agents. I don't think they hide from that. But yeah, I want to hear what he says, and then I'll respond.
Agents. They're not financial advisors. They're insurance agents. And what they just said is absolutely incorrect, 100% incorrect. So basically, insurance companies would rather you buy whole life insurance, not.
It's not true. Term insurance and index universal life are the most profitable products on the insurance balance or product line. Not only that, when he talked about being a return of premium earlier for whole life insurance, you're basically, as a whole life policyholder, you're sharing that dividend is a return of premium of the total premiums of the entire insurance company, not just your policy. You are sharing in the dividend of the profitability of the entire company, i.e., if they have IUL, if they have term insurance, when it's actually 99.1%, according to the new LIMRA statistic, of term insurance policies that never pay out. And so or DALBAR statistics, sorry. But when you look at that statistic and you realize that term insurance is a wildly profitable product for the insurance company. And as a policyholder of a whole life policy with a company that's selling these term policies, you're sharing in the profitability of those products. That's what they're talking about. And so once again, he's just talking about things he doesn't understand.
Term insurance, right? Because they make a lot of money off of whole life insurance also. Don't get it twisted. They make a lot of money off of whole life, especially the agents. And these guys are insurance agents. Absolutely, 100%. They're the only type of people in the
I got news for you. So he's not wrong. Some agents can make a lot of money selling whole life insurance. If you just sell 100% base policies, that's one thing. So I guess I do want to add the caveat, like the policies that I showed you there, that I just showed you on the board and walked through, we have to take about a 90% commission cut to be able to do that, right? But we do it because it's the right thing to do. Because serving people, and obviously we have a YouTube channel, we do all these things, and it's much more of a volume game than a one thing, and we're able to just serve people where they are and help solve problems. So if we were selling just base policies, then that would be the case. But once again, if he thinks that that's the only way to do it, don't come on here acting like an expert, talking like you know how all this stuff works when you're only talking about one side of it that fits your story, okay?
Financial world who would be pushing infinite banking, and that would be insurance agents. Let me explain why. The way insurance agents are paid, they don't have clients. Insurance agents don't have clients, they have customers because they sell a product in a way that—
You're such a dork. You, like, all financial advisors are glorified salespeople selling products. That's all it is. I don't care what it is. There's commissions, there's fees, there's all this stuff around the financial advisors forever, for Wells Fargo, for JP Morgan, for Smith Barney, for Merrill Lynch. They sold products, mutual funds, all these things. Are you a financial advisor if you sell a mutual fund? Well, guess what? You probably make a commission. And so, like, the argument that you don't have clients, you have customers, I would argue we serve our customers, our clients, however you want to phrase it, I don't really care. We serve the people in our community that decide to work with us better than 99.9% of financial advisors. You know what I mean? Like, it is what it is. It has nothing to do with you earning a commission on whether or not it's a client or a customer, however you want to phrase it. That's just a stupid statement.
An insurance agent is paid, normally in the life insurance world, they will get paid anywhere between 80 to maybe even 100% of whatever your annual payments are.
That's just not true. He's talking about things he doesn't understand. You have to break it down. Here, you want to see? I'll show you what it is. Let me do this. Let me go back here. I'm going to be transparent with y'all. Okay. This is because this is what I do. I don't know any other way to do it except for be transparent. I'm going to go back. I just so happen to have this page up here because I was doing this whole education thing. So here's the deal. What an agent is going to get is about 50%, maybe a little higher, depending on if they're successful. But the base commission of things is about 50%. Okay. And so what you can see here, I'm going to go to the 45-year-old, actually. Let's go to the 45-year-old so we can focus on the premium we're looking at. So 50%-ish of this base policy amount. Right here, you're looking at $2,399. And then we're looking at a 15-year term rider. You're going to make less on this, but it's there. You're going to make probably 30% of that number. Okay. This number, you're going to make zero, or you're going to make about 1.5%. Okay. That's what the insurance agent's going to make. Okay. So you got 2,600, like whatever that number is out of this whole, you're not making 50 to 100% on this. Like, you're making 50% of this number. Let me get my calculator out and I'll tell you what a typical agent would make on this policy. So we go 11, 9, so it's 12,000 essentially, or 2,400 is the base premium plus 276. I'm going to keep this round, equals that times 0.5. So it's 13 of base commission for that. And then he's got 9,323 times 0.015, $139 plus, so it's $1,447. Okay. And so this person would make about $1,447 on this deal, okay? And this is just coming right off the policy. This is just, you're looking, I'm just showing you exactly what's up and showing you how this works. Now, the other thing here is you could save that $12,000. You can pay as little as that on any given year that you need. So you have more flexibility between these two than you thought you had. But we're designing this for a savings alternative. We're designing it because I was trying to put you in a position, you know, I'm talking to you like you're actually doing it. But we're trying to put people in a position, you know, where they can actually, you know, have this situation where, you know, 132, they put in 120, they've got this savings going, they've got their cash value growing, it'll be amazing, you know, all these different things. And then they have the living benefits, they have the volatility buffer, they have all these things that if they do the buy term and invest the difference philosophy, they're going to lose out on all those benefits. And so I just really think everybody should be cautious about, you know, where they take their information and how they kind of proceed forward. Because this guy talks like he knows a lot, but hopefully, I mean, I know I'm spending a lot of time on this video. This is way longer than most videos I do, but I just think it's important. And the more I didn't realize how bad this is going to be. I got into it, and now I'm realizing, holy crap.
Right, for that first year. So let's say your payment is $100 a month, right? So if your payment is $100 a month, that goes to be $1,200 a year. And so the insurance agent.
I'm also noticing these videos are going to get longer and longer and longer. He reacts to them. I'm reacting to him, reacting to them. He could come back and react to me. These videos are like getting compounded. Before you know, we're going to have a 5-hour video. It's going to be funny.
The person who sold you that policy, they're going to make
nobody will watch it.
$1,200 off of selling you that product, right? I'm going off 100% for the first year. That doesn't keep going, but for the first year, they get that, right? Then they might have a little bit of residual. They might get a little bit of money.
You'll get a little trails. Typically, it's a 3 to 6% renewal every year going on whatever the $12,000 premium in the example that I showed. But once again, you're looking at, there's work. There's a lot of work that goes into helping people get this done and do it the right way. And there's, like if you break down though, I could break this down and say, all right, if you were managing my money and charging me a 1.5% managed money fee on the same money over the same time, you're going to make more money managing all my money that I'm giving you than I'm going to pay in commissions to the insurance agent. So that's something to consider.
If you keep going, but they got that $1,200 because of your term policy that was $100 a month. But with whole life insurance, if whole life insurance, let's say whole life is $1,000 a month. Right? So if whole life is $1,000 a month, instead of them getting paid $1,200, they're getting paid $12,000 to sell you a whole life insurance policy. So the incentive to the insurance agent is to get you into the whole life.
Yeah, no, the incentive, actually, it's not. I could sell you the $1,200 policy and I'm going to make almost as much. I mean, I just showed you here. Like, it's really not that much of a difference doing what we're talking about, right? So like, here, let me expand this again and I'll show you. I just like, this is the kind of stuff that I think is really important to understand. So like, there is no incentive. So like, let's look at this. Let's look at this, 84,000. Okay. Let's say you did 20-year term. What's more expensive? If I'm paying $1,200 a year on a 20-year term, that would be a situation where now at year 7 here doing whole life insurance, I've paid in $84,000, but I have $85,000 available and I have extra life insurance to go with it. So from that point forward, I'm saving, right? I have premium deposits of $12,000, but my policy is growing by $15,000 a year. Like, what is the actual cost? I'm ahead. The net of it all from a cash flow perspective, I'm saving, but the cost of insurance, what's more expensive? Paying $1,200 a year and going 20 years and spending $24,000 and just burning that, or getting to year 20 and having spent $219, but having $322 in cash and having a bigger death benefit, right? What's more expensive? You tell me. I don't know, right? Like, to me, and by the way, if we did it this way, I would probably suggest you actually supplement with additional term if you have a family, because obviously $500,000 or $300,000, $200,000 isn't enough to cut it. But this is a savings alternative. And so if I did a $1,200 premium, $1,200 premium, and I am going to get about 100% commission because that's what insurance companies pay higher on term. And so I got $1,200. And so I don't know, what did I do here? What was the last one? It was $1,200 versus $1,447. So when you're selling term or whole life, it's really, the agent doesn't have a lot more incentive to sell whole life insurance in that situation. But, you know, for you, the person, you can look at the math that I just shared with you and you can make your own decision. I mean, I don't care. Like, you do what you want to do. I don't got a horse in your race. You're probably not going to work with me. If you want to, there's a link in the description below. You can, but like, you know, to me, this is just one of those things. It's a no-brainer. And when you understand it, which he obviously doesn't, you know, it just, like I said, it's a no-brainer. I don't know.
Plan, right? It makes more financial sense for an insurance salesman to sell you whole life, not term. Why? Because they only make a little bit of money on term, because term policies are so cheap. They're going to push you into the whole life policy because that's where they can really make a whole lot of money. So,
and so he's not wrong in the sense of, if I did 100% base policy on the 12,000, you wouldn't have the cash value. And if I made the 50%, I'd make 6,000 instead of 1,200, right? And so from that perspective, he's not wrong. But once again, he either knows what he's doing and is intentionally angling for his own story and for his own like line of thinking. And so that's either happening, or he's just ignorant and he doesn't understand this. Like he said, I mean, at the beginning of the video, he said he understood how this worked. Okay. And so I'm going to take him at his word and believe him that he understands this. In that case, you're being deceptive and you're not actually, you know, telling the story. You're actually using this to manipulate people and not share the full truth. Okay. So I have a problem with that.
Always pay attention to what is the upside for the salesperson, right? If it makes more sense because they make more money for the whole life, then that's probably why these guys are pushing whole life. But a real financial advisor, any real financial advisor wouldn't push this, right? Like, once again, see all these books back here, these books over here, right? I've gone through years of education. And
do you want to see all my books? Go look at some of my past videos before I moved to the Dominican Republic and bought a hotel, right? Using my whole life policy and doing other things and running a private equity fund and all these things. Like, you don't need to just do things the classic way. It's not for everybody, okay? And I would argue that if you want to like live a bigger life, you're not going to be able to do what everybody else is doing. Once again, not that that's for everybody, but like, I'm sorry, but like, just pointing at books and like, that doesn't make you that smart. I'm sorry.
And financial planning and accounting and finance. If this infinite banking was a real way for a majority of people to build wealth, they would have taught it in these classes. Infinite banking is not new. Infinite banking has been around for years and years and years and years, but yet they don't teach this in financial planning courses. Why? Mm-hmm. Because in financial planning courses, they're going to teach you methods that are proven over a long period of time of how to build wealth for the majority of the population. Now, there are situations where this infinite banking could help a person. There are situations where a family would be better off with a whole life insurance plan. But for the vast majority of people, a term plan, by simply buying term and investing the difference, makes more sense for a majority of the population. So
I mean, I just showed you that, and he's not even considering the fact, if he's this big, okay, so if he's this big financial planner, as a financial planner, should you not be considering the long-term financial plan of your life? Are you not planning for retirement and considering what not just the accumulation is for your clients, but what the distribution is, what the way down of their life looks like? As they start to distribute money in retirement, making sure that they have an asset there to protect their assets, to protect their investments, making sure they have an asset there that is there for long-term care, making sure it's there because in case they become critically, chronically, and terminally ill, to be able to have dignity in life and be able to go through life that way, to be able to make sure on a guaranteed basis they can have a death benefit. Who are the people that want life insurance the most? I guarantee if you go talk to 100% of people that are 85 years old without insurance, and you ask them, do you wish you had insurance right now? 100% of them would say yes, and they can't get it, okay? And so like, that's the thing to think about. And like, the short-sightedness and like it drives me crazy.
They don't know what they're talking about, one. Two, they're incentivized to not know what they're talking about because as insurance agents, which I'm 99% sure they're insurance agents, because no one would be pushing infinite banking if they weren't making money off of infinite banking.
I got news for you. I was pushing infinite banking when I wasn't an insurance agent. I just got my license 2 years ago. We've been doing this. I was licensed before that, a decade before pretty much, or 8 years before. But, this concept is legit. You can argue against it all you want. He's just arguing against it because he's scared because he doesn't understand it, and he's proven he doesn't understand it.
They make money off this stuff. They're insurance agents, absolutely.
Mm-hmm. Which is the oldest product they offer is whole life insurance.
I'm sure he doesn't make any money on any of the content that he makes.
Now, again, to make sure
You
that we're on
shouldn't
the same
listen
page,
to
we are
him.
only
You
talking
can
about
make money.
savings. So we are talking about a warehouse for you to put your savings. We're not telling you to take your savings and invest it and risk losing it. We're talking about putting your savings in a vehicle that's going to earn a steady yet guaranteed rate of return.
I mean, there's a bunch of stuff they don't know what they're talking about. You can put your money into a bank and get a certain amount of interest. You can buy certain securities from the federal government that would have interest that is guaranteed. So the federal government has things that you can buy, different savings bonds, different things that the
You can, but it's not going to be liquid like what this
government offers that you can buy. Now, the interest isn't super, super high, but that's because the interest is guaranteed in your principal.
And this guaranteed interest for what it is, I always tell people it's like a bond alternative. It gets bond-like returns, municipal bond-like tax treatment, and money market-like liquidity. It's the trifecta. It's awesome.
Is guaranteed. So it's not only an insurance product. And then once again, you don't have free access to the money if you're buying a whole life plan. One, you have to build up enough in the cash value. Two, you can't even take out, it's not like you're just withdrawing the money. You're most likely borrowing the money and you're paying the company interest to borrow your own.
I've already answered that on the withdrawal, on the borrowing, on the liquidity.
Money. This is a grift.
Doesn't even know what he said.
Infinite banking and whole life insurance plans are not the best option for the majority of people. All right. This video is going way, way too long. I'm gonna give it a couple more minutes to see if they have a better explanation of how infinite banking works. But just to give you the basics of it, they want you to overfund, to overpay a whole life insurance policy so that you can build up as much and as fast as possible the cash value of the plan. So you can then, when you want to borrow money, instead of borrowing money from a bank or borrowing money from yourself through your savings account, you can borrow money from this whole life insurance cash value policy. But you'll still be paying the insurance company interest on that money. And you can't even borrow 100%. You can only borrow, let's say, 80 or 90% of the cash value. It doesn't make sense. It's like, why wouldn't I just cut out the middleman and just put the money into a money market account? And then when I want to borrow money, I can take it out whenever I want from my money market account. And then I can pay myself back to the money market account.
Because your money market account, when you pay it, when you take it out of your money market account, the money's no longer growing in your money market account. That's the power of doing this. Now you can go to, I remember I bought my first car. I had a little local bank credit union, and I did what's called a collateralized loan. I put $10,000 into, I bought my first car really cheap. I had $10,000 I had saved up. I wanted to get a loan. I didn't want to pay a lot of interest. I got a collateralized loan. I used the $10,000 to secure a cheaper loan, but I did it when I was like 22 years old to build credit, right? And I did this and it worked, right? And there are ways that you can do this, but it's all just on a much smaller scale. And the reason infinite banking is so powerful, because it's not just about how you make money, it's about how you secure it. It's about how you protect it. It's about how you pass it on to the next generation. And you know, they're not really landing the plane on that in this video, but that's what it's about. And if you want to be able to have all of that, and he said at the beginning, you can't have your cake and eat it too. Well, yeah, you can if you do it the right way and you understand this stuff. And once again, he obviously doesn't.
A whole life insurance plan. Remember, what happens when you miss a payment? Right? If I'm putting $500 a month into my own savings account, if I happen to miss a payment one month, nothing happens to me.
You can actually design it like I showed on there, the range of $12,000 all the way down to like $20 whatever $100. That is a range. You can pay far less, and if you miss a payment, there are all sorts of ways that you can miss that payment without having a negative consequence. So if you want to learn about that, you're gonna have to subscribe and hit the bell, because I talk about it on a lot of videos. I'm just not going to go into that much depth on this video because, as he said, this is getting pretty long.
There's no penalty. What if you miss an insurance premium payment? What if you lose your job, right? And you can't make that insurance premium payment? You can lose the insurance coverage. You can get hit with a bunch of fees. And even if you do get a refund, if your policy allows for you to get a refund,
there are actually riders you can put in place to protect you against all that.
A certain amount of the premiums that you paid into that whole life plan, you're still not getting 100% of your money because it's getting ate up with fees. So you basically,
I just showed you net what happened. And that's assuming the lowest dividend scale that we've had in 80 years. Okay. So I don't know.
Spent a whole lot of time buying into a whole life insurance plan, but because your policy lapsed, you were no longer able to make the payments. So you lose coverage. So you no longer have insurance. And then when you even get a refund back from a policy that allows for refunds, you're not getting the full amount of your money back, when you could have just put the money into a real savings account.
You're up to it,
borrowed from it, borrowing from yourself, because you built up a savings account of $10,000, $20,000, and you can pay it back whenever you want. And there's no set amount that you have to pay every month. So Pocket Watchers, infinite banking is a scam for the most part. whole life insurance is not a suitable policy for a majority of the population. There are situations, let's say you have a special needs child that's going to need a certain amount of insurance to make sure that, because a special needs child will never be able to financially take care of themselves. So you want to make sure that you have a policy that's not simply term, right? My personal term policy, I have insurance. My personal term policy won't go out until after all my children are adults. So after all my children are adults and they should be able to take care of themselves, as long as I'm doing my job as a parent the right way, there's no need for me to continue to have that insurance policy. That's why I have the insurance, in case I die in the meantime, before I give them an opportunity to become adults and be able to make money for themselves. Now, what am I doing with that difference? The difference between
I buy insurance for a different reason. I buy insurance to make sure that what I want to happen in this lifetime will happen. It'll actualize. No matter what, I'm able to leave a legacy. I'm able to make my money and have my life and have my wealth protected and have a backstop and have a legacy and a generational legacy passed on to the next generation, and have a set of rules and a system set in place with using trusts and stuff to be able to have the next generation better off than I was. Maybe I'm more passionate about making sure the next generation is taken care of because I grew up with nothing, and I grew up with a lot of love and great parents, but not a whole lot, and I want to be able to make sure that that's done,
my term policy and what I would pay for a whole life policy. Well, I'm investing in my personal companies. I'm investing in the stock market so that there still is a good amount of net worth. So when I do pass, they still have an inheritance. It's just not coming in the form of life insurance, because they're all going to.
If you're passing money to your heirs without life insurance, you're not passing it on in the most tax advantaged way. That's like the fact that he's like, once again, speaking out of both sides of his mouth. Dude, you're an accountant. Do you like paying the government taxes? Is that the kind of accountant you are? Like, if you leave, a 401k or qualified money to your heirs, there's going to be a problem, right? Like, wouldn't you rather leave money to your heirs that's completely tax-free?
And spend at the lowest 25 years old to 30 years old by the time I die, if I beat
really good
the life insurance policy that I have. So Pocket Watchers, anytime you hear the words infinite, forever, perpetual in a financial strategy, know that it's a grift, right? There's no resource in this world that is forever. There's no resource that's never ending. I remember when I was a little kid and a science teacher told me that one day the sun in the sky is going to burn out, because all stars burn out at some time. Now, it may be billions of years from now, but at some point, the sun will burn out. That's the way you got to think about investing. The second someone says that it's never ending, it's infinite banking. It's a grift. It's a scam. If you want an insurance policy for a majority of the people, simply buy term, invest the difference, have enough between 3 to 6 months of your emergency savings fund. So when emergencies pop off,
3 to 6 months is not nearly enough. Anyway, if you kind of realize that that's kind of just half-baked advice, 3 to 6 months in an emergency fund is enough, and you think that's going to get you, that might protect you if you lose your job, right? But what's an emergency? If you're 45 years old and you get diagnosed with cancer, which, by the way, I have 3 people that I know in their 40s right now that just got diagnosed with cancer and are going to have a hard time working. If you had that happen to you and you got to do chemo and radiation, and to me, that's an emergency. What's 3 months of savings going to do for you in that spot? I don't know, JT. To me, maybe an emergency fund should actually count for it if you become, diagnosed with a terminal illness like cancer, so you could accelerate the death benefit. And even if you don't use that for medical treatments and you want to use the traditional chemo and radiation, you could utilize that money to help you get through life and help cover your family's bills and help make sure your house and all your debts are paid off and everything is good to go while you're alive, right? Like, to me, that's an emergency fund. An emergency fund, like you losing your job for 3 to 6 months, if that's an emergency for you, we got a problem. Like, we need to think bigger. If you think that a 3 to 6 month potential job loss is your real emergency and that's as bad as it gets, I got news for you. Life is going to be hard. You're going to have a lot of things happen to you that you're not going to be prepared for, and it's going to be challenging. And so anyway, hopefully you found value in this. JT, if you are watching this, if somebody wants to share this with him, get it out there. I'm happy to do a live conversation with him anytime. JT, come on down to the Dominican. We'll do it live in my studio. I'll put you up at the hotel. We'll have fun. But anyway, that is it. Till next time, have a blessed, inspirational day. If you haven't already, make sure you're subscribing, hit the bell. That way you're notified every time I launch a new video. We'll talk soon.